Today we're going to be looking at the S&P 500. I'll give you my thoughts on what to look out for in the near term, as well as discuss what happened yesterday when Jerome Powell testified in front of Congress. We had a strong push to the downside. He made a lot of bearish or hawkish statements that suggest there's more downside in markets in the future. Now, looking at the S&P 500, just recently we've pushed up into this supply zone and ultimately rejected, had a move down here, held this support line, came back up to retest that zone, and then of course Jerome Powell pushed us down lower. Now obviously looking at the longer term trend, we did break out and push to the upside, which is usually a strong signal that a potential bottom could be in. If you're looking at purely at technicals, kind of a weird thing happened October. We had that strong push to the downside. We broke into new lows. And then ever since then, we've been in this uptrend, and inflation data has continued to push higher. And so that suggests that the Fed might have to do more. They might have to tighten more. They might have to raise rates higher for longer in order to keep inflation down. And really what signaled the start of the Fed starting to switch their mind about, keeping rates around 4.75 to 5% terminal, then even potentially lowering rates in Q3, Q4 of this year, is the hot jobs report in January. So unemployment is still at record lows. Wages are still going higher. You're seeing PMI and other indicators suggesting that the economy is still really strong. There's still a ton of liquidity in the market, shown by this chart. They've printed up to $9 trillion, and they're tightening the balance sheet, but it's just this slow, drawn out process that's going to take quite some time, probably years, for them to even get this back down to a reasonable level. And because there's so much liquidity in the market, if they let off the brakes, the market's going to start to run away. Inflation's going to go higher. And just to break down what Jerome Powell said yesterday, obviously they're not trying to raise the unemployment rate directly. They can't say that, but everything that they're doing to create disinflation directly affects unemployment or jobs. So ultimately, to have a recession and to get inflation down, they're going to have to create unemployment. That happened in the 70s and every other period that we've had high inflation. There is a recession, people get laid off, unemployment goes higher. They've been saying a lot here that, we haven't seen the full effect of rate hikes. There's no big spike in business debt. Obviously, if there was a big spike in business debt, that could suggest that we're getting closer into a recession. But because sales and earnings are still robust, there's no need for companies to take out debt financing. Another thing is that he said that the data suggests nothing about the data suggests that we have tightened too much, and rather we have more work to do. So that could mean higher rates for longer. We're going to have a higher terminal rate in our next steps. And so if you've been tracking the Fed Monitor tool here, this shows the percent chance at the FOMC meeting. And right now we're at 73% of a 50 basis point rate hike, which changed. We were on pace to only raise 25 basis points. And so that might flip. The Fed might repivot and start to raise rates higher again. Just looking at the overall market structure, though, I do think that we will push lower, especially with the chance that rates will be higher for longer. Obviously, right now the market is hyper-focused on what the Fed is going to do, and it's kind of in this upside-down world where if we have really good news about jobs or PMI or wages, the market actually sells off because everything is tied to a discount rate, which is directly affected by the Fed rate. And so it kind of acts like gravity in a way. If rates go higher, then valuations go lower, and so does the market. And the same thing with, well, if they start to lower rates, then you've had this push to the upside. And obviously it's pretty evident when they lowered rates and printed a bunch of money. We had inflation, not only in price and goods and services, but also the overall market. And the same thing is going to happen here. We're going to have slowing growth. Eventually unemployment will have to go higher. Inflation will ultimately come down, but so will prices. And so the market is also directly tied to what inflation is. And if the Fed wants to bring back any sense of normalcy, then they're going to have to push this lower. And at some point, there's going to be a level. I don't know what that exact level is, but we're going to hit a level, and Jerome Powell, the Fed, they're going to say uncle. They're going to tap out. They're going to start to lower rates again, and we'll have a pushback to the upside. So that's really all you have to look for from like a macro perspective, is that the bottom will unlikely be in until the Fed actually pivots. And you'll know that things are really bad when the Fed does pivot. Unemployment will be much higher. Maybe it'll be 7%. Maybe it could even get all the way to 10%. I really doubt it. I think that the Fed will tap out and begin to lower rates and potentially even print money again, which has a bunch of other implications that I can talk about later in another video. But that's what you got to watch for now. Jerome Powell is going to testify again today in front of Congress. He pretty much said everything that he had to yesterday. And then really what I think the market's going to be looking for is on March 14th, we have CPI data from February. And then on March 22nd, of course, FOMC. And so if Jerome Powell does raise 50 basis points, obviously that will be bearish for market price. If he only does 25 basis points for some reason, then we're going to have a strong push to the upside. But obviously a lot of it's going to be dependent on the data, and that's going to be on the 14th of March. That's it for this video. Hope you enjoyed. Make sure you hit that subscribe button, and I'll see you in the next one.